Not all real estate deals go according to plan. In fact, sometimes they turn into absolute nightmares. And that's exactly what happened to me and some of my fellow investors. Now imagine this: a strong market, a solid sponsor, and a promising investment opportunity. Everything checks out. I did my due diligence, I knew the submarket, and I truly believed in this deal. But then, out of nowhere, things started falling apart. Partner breakups, financial chaos, rising interest rates, and eventually silence. Investors were left in the dark, including me. Now in this video, I'm pulling back the curtain on one of my worst real estate experiences. What went wrong, the painful lessons I learned, and most importantly, how you can avoid making the same mistakes. All right, so let me take you back when this all started. I was looking at a submarket that I knew very well. It was close to where I live, and I could literally walk the streets and see the development happening. This area was chef kiss, right in the path of progress. New businesses moving in, infrastructure improvements, population growth. It checked all the boxes. I found a real estate company that shared the same vision, and they were already actively acquiring properties, renovating units, and repositioning assets in the same submarket I was interested in. They shared the same thesis as I did, and they already had an incredible head start. They already owned 1,500 units under management in that submarket. They had an in-house construction team and solid relationships with the town. They were vertically integrated, meaning they controlled every part of the process, from acquiring the property to property management to renovations and construction, which in theory should have minimized risk. On paper, this was almost a dream scenario from an investor's perspective. And initially it was. The first two deals went great. They were coming along well. The company was executing well, acquiring more properties, and things looked promising until they didn't. Now, what happened next is something no investor can fully underwrite for. The partnership split up. The two founding members of the company had very complementary skill sets, a yin and yang. One was a master at acquiring acquisitions, underwriting, and managing real estate. The other founding member handled the back end. He was in the background, but he was very good at what he did, which was securing finances, raising capital, and running the operations team. In fact, he had hired and put together a staff of 60 people. But then they had personal, irreconcilable differences, and the partnership split up. And the guy who left the company, he was the one keeping the machine running. He was the guy that was handling the 60 plus employees, managing the finances, managing the operations, and making sure investor reporting was timely. And the moment he left, it was a bad omen, and things started to crumble. Reporting slowed down, then became inconsistent. The financials were an absolute mess. Investors, including me, were suddenly in limbo. But we still had hope and believed that things would work out. The remaining founder, he was dedicated. He's still dedicated to this day to fight and save this portfolio, as all of his net worth is tied up in it. And there's a clear alignment of interest between investors and him, because we all want to see the portfolio do well. But we were in a pandemic, and after all, things were tough everywhere. So we just had to be patient, right? Maybe that's why the reporting started getting inconsistent. Then came the real gut punch. The Federal Reserve started aggressively hiking interest rates to fight inflation. And suddenly, anyone holding floating rate debt saw their mortgage payments double. Now, the majority of this portfolio had fixed rate debt, which was great. But here's the things that went wrong. The sponsor had other parts of the portfolio on floating rate debt. These were loans on properties that we had not invested in. However, the founder, instead of keeping them separate, or the sponsor, I should say, instead of keeping them separate, all the properties, they were all lumped into one company. Now, what did that mean for us? We had invested in a deal with fixed rate debt, and that should mean that interest rates going up shouldn't affect us. But even though our deal was structured conservatively, we were still exposed to risk from the other properties in the portfolio. And since they were all lumped together, when those floating rates ballooned, it created massive financial stress, creating a significant drag on the entire portfolio. Now, had they structured this properly, with separate LLCs for each investment, our investment would have been insulated from the problems elsewhere in the portfolio, in their portfolio. But because everything was under one umbrella, we all felt the pain. Now, the last we had contact with this sponsor, he was in the process of negotiating with 3 of his lenders, 3 different significant lenders within the real estate portfolio of this sponsor. And they emerged from one, but at this point, this is where the communication from the sponsor and us, me, completely broke down. Despite multiple texts, emails, and calls, we received a cryptic email saying that they could no longer comment due to legal reasons. And just like that, investors were left in the dark. Now look, I don't share this story to scare you away from investing. I share it because even great deals with great sponsors can go wrong. And if you're in this game long enough, you'll take some hits. But what separates the best investors from the rest is how they learn from these experiences. Lesson number 1, key person risk matters. Understanding who the sponsorship team is, understanding who the key principals are, is paramount. Typically, it's 1 or 2 people. Now, if there is a partnership on the sponsorship team, what key skill sets are each of them bringing to the company? And what will each of them be responsible for? Now, in this case, in our example, there was an excellent fit professionally between the 2 founders. However, there wasn't a good fit personally. Now, this is a lot harder to detect unless you spend considerable time with them. And I did spend quite a bit of time getting to know them before ever doing an investment. I also hung out at the property management company to get a feel for the company and the employees, as well as shared several dinners with the sponsors. And at dinner, they did have some tit for tat back and forth between the 2. And at the time, I wrote it off as locker room banter. But it was actually the makings of a deepening dislike for each other. Now, again, this is something that is very hard, is very nuanced to even think that, hey, a partnership is going to break up, but nothing is beyond the scope of possibility. Lesson number 2, the debt structure can make or break you. Now, our investment had fixed rate debt, but because the sponsor didn't structure the portfolio the correct way, we ended up being exposed by distressed assets in other parts of their portfolio. Now, that decision put the entire portfolio at risk. Learning to understand the organizational chart, the structure of ownership, who manages and controls it, these are all things, very important things to look at and consider before making an investment. Lesson number 3, transparency is everything. If a sponsor starts delaying reports, withholding information, or dodging questions, that's a sign of bigger issues. As investors, we need clear, timely, and honest reporting, always. And you'll find that the best sponsors will tend to over-communicate rather than under-communicate during distress time. They know that investors are anxious, and they want to give them answers. And even if it's bad news, they over-communicate and let investors know what the problem is and what is being done to remedy the situation. Lesson number 4, deals can take time. Now, this deal is still ongoing. Investor capital has not been lost yet, but this is a deal that has some distress. And I will continue to provide updates as I learn more and as this deal progresses. But one thing we can be sure is this experience has been a painful reminder that not all investments have quick, clear outcomes. All right, guys, but now here's the truth. Even with all the knowledge, all the experience, all the due diligence, it is impossible to completely eliminate risk in passive investments. In fact, it is impossible to eliminate risk in any investment, period. But what we can do is get smarter, learn from these experiences, lean on each other. I want to share all these lessons I learned with our colleagues so we can decrease the chances of costly mistakes. Remember, we're all in this boat together as dentists. And let's help each other do more, build more, and achieve more. All right, guys, if you found this video helpful, hit the like button and drop a comment below. Have you ever been in a bad investment? What did you learn? And if you want to learn how to invest smarter and avoid costly mistakes like this, join my Facebook group. It's called Financial Freedom for Dentists. It's a community of professionals learning to invest passively and build real wealth. Thank you for watching, and I'll see you on the next one.